Hey friends, welcome to the Singapore Market Digest for April 24th, 2025. I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX. The Singapore market has been showing some interesting movements, with several key companies releasing their quarterly updates. Let's break down what's been happening with some of the notable players on the exchange. First up, we have Keppel, which released a pretty impressive Q1 2025 update today. The company reported a net profit increase of over 25% year-on-year, excluding their legacy offshore and marine assets. If we include those legacy assets, their profit would have more than doubled, mainly due to reduced losses from that legacy portfolio. This strong performance was driven by their infrastructure, real estate, and asset management segments, which have been firing on all cylinders. Keppel's recurring income accounted for more than 80% of its Q1 net profit, showing the success of their transformation into an asset-light, recurring income-driven company. On the monetization front, Keppel has been busy, reporting $347 million in assets monetized year-to-date, mostly from divestments of real estate assets in China and Vietnam. They're not stopping there. They've got another $550 million of potential real estate divestments in advanced stages of negotiations. That's a significant amount of capital they're freeing up for future investments. In addition to these financial updates, Keppel announced on Wednesday that they're entering a joint venture with Tianjin Shunhua Real Estate Construction Management. This partnership will focus on developing 19 plots of land in the Tianjin Eco-City Northern District in China. As part of this agreement, Tianjin Shunhua will pay Keppel Hongda about 503.3 million yuan, $92.8 million, for a 30% stake in Tianjin Fulong Property Development, which is the developer of the Northern District project. This move aligns with Keppel's asset monetization program and strategy to collaborate with experienced real estate partners for large-scale developments. The market seems to like these developments, as Keppel's counter-closed SORA 15, or 2.4% higher, at $6.40 on Wednesday, before their announcement, and climbed another 3.6%, or STAR 23, after today's update, reaching $6.63 in morning trading. In the infrastructure segment, Keppel reported that their 600-megawatt hydrogen-ready Keppel Sacra-Kogan plant reached commissioning readiness in Q1 and is on track to start operations in the first half of 2026. The company also ceded a 39% stake in the 1.3 gigawatt Keppel Merlimau Kogan plant to the Keppel Core Infrastructure Fund. About 66% of Keppel's contracted power generation capacity was locked in for 3 years and above as of end March 2025, providing stable recurring income. Moving on to the REIT sector, Mapletree Logistics Trust, or MLT, released their Q4 results, and the numbers were a bit of a mixed bag. Their distribution per unit fell 11.6% to $0.09955, which isn't great news for income-focused investors. This decline was attributed to lower revenue contribution from China and weak regional currencies, factors that are affecting many Singapore companies with regional exposure. Looking at the specifics, MLT's gross revenue for the 3 months ended March 31st dipped 0.8% to $179.6 million compared to a year earlier. Net property income also took a hit, falling 1.6% to $152.8 million. The operational challenges in China aren't new for MLT. Management had previously guided that it would take 12-15 months for its China operations to base out and recover, with MLT focusing on maintaining occupancies while rents are generally expected to drop around 15% through the course of the financial year ending March 2025. Despite these headwinds, MLT reported an average positive rental reversion of 5.1% across its portfolio in Q4 FY25, though the performance was uneven. Japan properties had the highest reversion of 15.7%, while China properties had a negative reversion of 9.4%. Looking at MLT's full-year results, gross revenue slid 0.9% to $727 million, while NPI dropped 1.5% to $625.3 million. The amount distributable to unit holders declined 9.1% to $406.4 million, hit by higher borrowing costs and lower divestment gain. DPU for the year fell 10.6% to $0.8053. Despite these results, units of MLT closed $0.04 or 3.4% higher at $1.21 before the news was released, suggesting investors might have been expecting worse or are focusing on longer-term prospects. Another REIT making moves is Mapletree Industrial Trust, or MIT. They've proposed to divest their data center in Georgia, U.S., for a sale price of $11.8 million. This single-story data center has a net lettable area of about 32,740 square feet and sits on freehold land spanning approximately 341 square feet within the Northwoods Business Center. The sale price represents an 18.6% premium above the independent valuation of $995 million as of March 31st, 2025. This is part of MIT's strategy to unlock value and redeploy capital elsewhere. Lily Lur, the CEO of the manager, emphasized that this move aligns with MIT's focus on portfolio rejuvenation to deliver returns to unit holders. It's worth noting that the property contributed only about 0.1% to MIT's portfolio gross revenue in FY 2024, and the current lease expires in August 2025. After evaluating all viable options and considering the property's small land plot, the manager concluded that divesting at the offered price was in the best interest of unit holders. The proposed divestment is expected to complete in Q2 2025, and MIT's counter closed on Wednesday 1%, or still a bit higher at $2.05, indicating cautious optimism from the market about this strategic move. Capitaland China Trust also released their results today, and the numbers reflect some of the challenges in the Chinese market. The manager posted a net property income of 292.5 million yuan, about 52.8 million, which is down 6.6% from 313.1 million yuan in the same period last year. Gross revenue stood at 439.7 million yuan, 6.1% down from 468.1 million yuan previously. This decrease came from both retail and business park revenue declining, specifically due to lower rents at Capitaland Sinan and lower occupancy at the Singapore Hangzhou Science Technology Park Phase 2 and Ascendus Innovation Towers. Despite these challenges, Capitaland China Trust's retail sector maintained a high occupancy of 97.7% and achieved a positive rental reversion of 0.5%, boosted by Capitaland Shijimen and Capitaland Xuefu. The business and logistics park segment also maintained stable occupancies at 83.7% and 95.7%, respectively. These results highlight the ongoing challenges in the Chinese property market, but also show some resilience in certain segments. Units of Capitaland China Trust closed 3.8%, or $0.25 higher at $0.69 on Wednesday before the update was released. Looking at Capitaland China Trust's longer-term performance, their FY 2024 results showed a 16.2% year-on-year decline in distributions per unit to 5.65 cents, with distributable income down 15% to $96.8 million. Revenue during FY 2024 fell by 3.9% to $1,837.6 million due to the absence of contributions from divested properties and lower occupancy and rents in business parks and logistics parks. However, the three malls that underwent asset enhancement initiatives, Capitaland Yueying, Rock Square, and Capitaland Grand Canyon, saw improved performance, achieving a 13.7% year-on-year growth in NPI and a blended return on investment of about 14%. In contrast to some of the challenges faced by other REITs, DigitalCore REIT delivered some positive news. The manager of this data center-focused REIT reported on Wednesday that they posted a distributable income attributable to unit holders of $11.7 million for the 3 months ended March 31st, which is 9.9% higher than the year-ago period. Their net property income rose by an impressive 41.8% year-on-year to $22.4 million, and revenue for Q1 jumped a whopping 79.9% to $44.2 million compared to the same quarter in 24. These strong results reflect the growing demand for data center space globally, driven by AI and cloud computing trends. DigitalCore REIT has been making strategic moves to strengthen its portfolio. They recently completed the backfilling of their Toronto data center, signing a 3-year lease with a next-generation AI computing developer that commenced in Q1 2025. This new tenant accounted for 33% of capacity for the Toronto data center, restoring occupancy from 66% to 100%. The new tenant is expected to generate an annualized rent of $4.2 million, which increases annualized rent for the Toronto data center by 45%. As a result, DigitalCore REIT's portfolio occupancy further improved by 4 percentage points quarter on quarter to 97% in Q4 24. Occupancy at the REIT's data centers in Frankfurt, which account for 29% of DigitalCore's portfolio, was 99.6% as at March 31st, slightly higher than 99.5% the year before. Occupancy at the data centers in Northern Virginia and Silicon Valley, which account for 40% of the REIT's portfolio, remained unchanged at 100%. Units of the REIT advanced US $0.005s, or 1.06%, to close at US $48 before the update, showing investor confidence in their performance and strategy. Looking at these results collectively, we're seeing a mixed bag in the Singapore market. Companies with exposure to infrastructure and data centers like Keppel and DigitalCore REIT are showing strength. Meanwhile, those with significant exposure to China's property market, like Capitaland China Trust, are facing more challenges. The logistics sector, represented by MLT, is dealing with regional currency pressures and varying demand across Asia. For investors, these results highlight the importance of diversification across sectors and geographies. The Singapore market continues to offer opportunities, but selectivity is key in the current environment. Companies that are actively managing their portfolios through strategic divestments and new ventures, like Keppel and MIT, may be better positioned to navigate the changing economic landscape. The data center sector appears to be a bright spot, with DigitalCore REIT showing strong growth in revenue and distributable income. This aligns with global trends in digital transformation and the increasing demand for data storage and processing capacity. On the other hand, companies with significant exposure to China are facing headwinds due to the country's economic slowdown and property market challenges. Interest rates continue to be a factor affecting REITs, with higher borrowing costs impacting distributable income across the sector. Companies are responding by hedging their debt exposure and focusing on operational efficiency to mitigate these impacts. That's the scoop for today. Remember to do your own research before making any investment decisions. This is Iggy from the Investing Iguana, signing off.